Chapter 3. This online course primarily explores an approach designed to support organizations in assessing their corporate governance practices with the aim of improving their corporate governance framework. In this session, we introduce a three-phased approach which companies can utilize to evaluate their practices. These phases are: Phase 1, Assessment. Step 1. Complete online self-assessment to determine level rating for 24 corporate governance indicators. Step 2. Use framework guide to identify recommended actions for level improvement. Phase 2. Plan. Step 3. Work with chairman to develop a phased plan for implementing the improvement. Step 4. Board approval for action implementation. Phase 3. Execute and evaluate. Step 5. Action implementation. Step 6. Redo self-assessment 1 year after to measure improvement. This course primarily focuses on Phase 1, Assessment, and provides insight into the Corporate Governance Maturity Framework Assessment tool. A brief overview of Phase 2 and Phase 3 will also be discussed. In order to appreciate the CGMF, it is necessary to understand the context in which it is meant to operate. Thus, we begin by firstly providing a brief overview of corporate governance and the benefits associated with having an effective corporate governance framework, the practices, policies, procedures, and principles. Chapter 4. The Energy Chamber of Trinidad and Tobago's Corporate Governance Maturity Framework was developed as part of an Inter-American Development Bank-funded project aimed at improving the practice of corporate governance in private and public companies in Trinidad and Tobago. The framework, grounded in international best practice and customized for the Trinidad and Tobago context, addresses the specific corporate governance practices relevant to three types of organizations: closely held companies, which are private, non-public, where a majority of the shares are held by one or a few owners; listed companies, companies listed on the stock exchange; and state-owned enterprises, organizations where the government of the Republic of Trinidad and Tobago has controlling interest. This Corporate Governance Framework Guide will provide the essential guidance for the directors, board members, CEOs, and senior managers of these organizations as they work towards a higher level of best practice maturity in corporate governance. Each of the 24 corporate governance indicators is structured into 4 levels of maturity, providing a clear path for chairmen, directors, and CEOs to move from basic compliance with legal requirements, Level 1, to advanced governance practices, Level 4. These are: Level 1, complying with legal baseline. This level speaks to legal requirements related to the specific indicator within the jurisdiction of Trinidad and Tobago. Level 2, understanding the need to professionalize corporate governance. At this level, an organization has understood the benefits associated with this governance dimension and has developed a formal procedure to address. Level 3, significant concrete steps. At this level, there is evidence that the organization has acted on or implemented the formalized governance procedures of Level 2. Level 4, advanced governance practice. At this level, the organization has mastered the corporate governance practices. In order to assess your organization's current level, your first step would be to complete the online self-assessment to determine your organization's level rating against 24 corporate governance indicators. Once this is completed, your organization will be in a better position to chart the way forward towards best practice implementation. In later slides, a phased approach will be provided to help you better assess and implement policies, practices, etc. for improved governance. CGMF Key Area 1. Roles. The core functions of the board are to communicate with the owners, to guide executives, and to monitor the performance of the company. In executing their role, directors analyze three specific areas. The CGMF3 indicators are identified as division of roles, duty of care, and duty of loyalty. Indicator 1. Division of roles. Boards have primarily an oversight function. The board adds value by determining what results are to be achieved, testing the assumptions and strategies that management develops for achieving these results, monitoring and reporting to owners, and communicating with other major stakeholders while offering its advice to the executive on high-level strategic issues. Best practice recommends that the board and management have distinct roles. There is a clear distinction between the decisions taken by the board and the running of the business. Best practice boards do not become involved in management or micromanage decisions. Indicator 2. Duty of care. The duty of care is an obligation imposed on the board that they act on and take decisions on a fully informed basis and with due diligence. To be fully informed, the board needs high-quality information on which it can base its decisions. The information must also be complete and provided on a timely basis. Information needs to be uncensored by management. The board makes important decisions that are founded upon the best possible available information as well as informed, rigorous, and open debate. An absence of good information leads to a weak decision-making process. Best practice indicates that acting with due diligence means that directors need to responsibly apply the skills they reasonably can be expected to possess based on their collective experience, knowledge, skills, and qualifications. Indicator 3. Duty of loyalty. The duty of loyalty means that directors act exclusively in the interest of the company and its shareholders and do not allow their personal or any other singular interests to prevail. Sometimes referred to as a director's fiduciary duty, this responsibility assumes the director takes the role of 1. A representative acting on the company's behalf, and 2. An agent who controls the company's assets. Best practice: the duty of loyalty requires directors to take decisions objectively and in an exclusive interest of the company. Any possibility of conflicts of interest are avoided by first declaring any interest that could conflict with that of the company, and then not taking part in decisions involving the conflicting interests. CGMF Key Area 2. Board Composition. Indicator 4. Appropriate composition. Boards require different skill sets, experience, perspectives, and personalities to properly fulfill their roles. Board composition should be adapted over time to the evolving needs of the company. The aim is to maintain an appropriate balance of skills and experience, executive, non-executive directors, and independent directors on the board. The Trinidad and Tobago Companies Act is silent on the composition of the board and the skills and experience of board members, although, having regard to the director's duties at sections 60B and 99(1)(a) and B of the CA, it appears implicit that in order to properly and effectively discharge their obligations, a director must have the appropriate competence and skill set to direct the management of the company. Best practice recommends that the skills and experience of board members are appropriate to the requirements of the business. Indicator 5. Choosing directors. Board members should be appointed based on qualities that they bring to the board and the company to help them achieve company goals. Qualities can be technical, such as financial skills, industry knowledge, legal expertise, or marketing expertise, but can also be soft skills like leadership and motivation for serving. Best practice: the board member nominations process is formal, documented, and transparent. Board members are appointed based exclusively on merit. Indicator 6. Independence for oversight. Independence is a quality that permits the board to make unbiased decisions in the interest of the company. Such independence requires a sufficient number of independent board members. This ensures that no individual or small group of individuals can dominate the board's decision-making process. Best practice recommends that the board has sufficient independence to allow it to exercise unbiased oversight of the company. Indicator 7. Number of directors. A typical range of board size would be from 5 to 10 members. Excessively small boards have insufficient manpower and skills. Excessively large boards have cumbersome decision-making processes, which may lead to some directors seldom making contributions and therefore being non-effective. Best practice recommends that board size is appropriate for the requirements of the business. There is no single optimal board size, as the correct board size depends upon the circumstances of the company. CGMF Key Area 3. Board Tasks. Indicator 8. Directing, delegating, and monitoring. Boards have a variety of responsibilities related to the monitoring, guiding, and directing of management and the enterprise. Some of the key responsibilities of the board are to review and guide corporate strategy as proposed by management, review and guide major plans of action, including annual budgets and/or business plans, agree and set performance objectives with management and monitor management's implementation of plans, evaluate, select, and dismiss the CEO, oversee the setting of remuneration practices and approve remuneration plans, oversee major capital expenditures, monitor the effectiveness of the company's governance practices. Best practice: the board fulfills certain expected responsibilities, establishing an effective link with owners, directing management, and assuring that the executive adheres to board policies through monitoring. Indicator 9. Risk oversight and board audit. An area which is closely related to corporate strategy is risk policy. This involves specifying the types and degree of risk that a company is willing to accept in pursuit of its goals. It is thus a critical task for management to manage risks to meet the company's desired risk profile. Of all of the committees of the board, the Audit Committee is the most important, as it has the responsibility for overseeing the control and reporting environment of the company. The Audit Committee is not a legal requirement, but for SOEs and LCs, it is a regulatory requirement, and for CHCs, risk oversight is implicitly required. Boards must determine the degree of risk that the company will accept to achieve its goals. Risk policies should identify all major risks and ensure that those with a high impact and a high probability of occurrence are effectively managed. Best practice recommends that the board ensures that all business risks are identified, evaluated, and suitably managed. The board has established an audit committee and, in the case of smaller CHC or family businesses, an internal control and risk oversight function is set up and working. Indicator 10. Internal audit. Internal audit is an independent, objective assurance and consulting activity designed to add value and improve an organization's operations. It brings a systematic approach to improving the effectiveness of risk management, control, and governance processes. They must consider whether an internal audit function is necessary and justifiable in view of the size and sophistication of the company. Internal audit's role is to monitor and evaluate the company's internal control environment to validate that controls are effective in mitigating risks. To maintain their independence, open communication between the board, Audit committee, external auditor, and internal audit function should be facilitated. The internal audit is traditionally subject to dual reporting responsibilities. In principle, reporting to management administratively and to the board functionally. Best practice: the company has an internal audit function. The internal auditor has a direct reporting relationship to the audit committee and the board. Indicator 11. Conflict of interest. A conflict of interest occurs when an individual or organization has multiple interests, one of which could possibly corrupt their motivation in a transaction. Conflicts of interest commonly result from family interests, ownership of other companies, gifts from friends or business partners, multiple places of employment, and self-dealing, that is, entering into a transaction with oneself or a related party. Best practice recommends that the board has systems in place for monitoring against conflicts of interest, misuse of company assets, and related party transactions. The company should have a written conflict of interest policy. Such a policy covers related party transactions and outlines how the company will monitor and resolve conflicts of interest. Such a policy may be found in the bylaws, an internal code of ethics, board charter, or in a corporate governance code. There should also be a written policy with respect to related party transactions. A related party may include board members of the company, its parent, affiliated or sister companies and associates, a parent, subsidiary, or affiliated company, except 100% or wholly owned subsidiaries and parent companies, the CEO, general manager, or key officers, including anyone who directly reports to the board or to the CEO, any significant shareholder having the ability to control or exercise a significant influence on the outcome of resolutions voted on by share owners or directors of the company, its parent, affiliated or associated companies, the father, mother, sons, daughters, husband, or wife of any of the natural persons listed above. Any business and the directors, CEO, and key officers of any business in which the natural persons listed above own jointly or severally at least 20% of the voting rights. Any person whose judgment or decisions could be influenced as a consequence of an arrangement or relationship between or involving themselves and any of the above persons. Indicator 12. Compliance function. The compliance function is designed to protect the company from the risk of failure in processes and losses and fines from regulatory inspection. The compliance function assesses the conformity of internal codes of conduct, policies or internal procedures with legal obligations and best practices applicable to its business. The compliance function ensures that the legal rights of stakeholders are respected. Best practice recommends that the company has a compliance function or systems that are able to ensure that the company complies with laws and regulations. The board should ensure that the company has a functioning system and staff to conduct the compliance function. In small, closely held companies, it is not necessary for a separate compliance function employee. Instead, the role can be assigned to someone with other duties as well. A documented compliance manual should be updated at least annually and include best practice guidelines and template examples. This needs to be a user-friendly, plain language document that covers at least the following: risk identification process, compliance risk management plan development and implementation, monitoring plan and methods of monitoring, reporting on non-compliance, for example, forums and templates and reporting lines, escalation of non-compliance issues, special projects, relationships built with regulators, industry bodies, other governance functions such as internal audit. Indicator 13. Whistleblower policy. A whistleblower policy allows the board to be informed of illegal or unethical practices and protects the whistleblower from reprisal. Such a system allows for any violation of government regulations or company policies to be easily identified and managed, helping to minimize any losses from damage to the company's reputation or from a decline in its competitiveness and in the productivity of its employees. Best practice recommends that the board puts in place a whistleblower policy to communicate illegal or unethical practices to the board. In addition, the board ensures the protection of the whistleblower's identity and their rights. A proper whistleblower policy must consider the interests of the person or persons who is or are the subject of the complaint, the interests of the whistleblower, responses and investigatory procedures that are complete, thorough, and non-threatening. CJMF Key Area 4 Board Processes. Indicator 14 Separation of Chairman and CEO. In some countries, the position of board chairman and the CEO have traditionally been occupied by the same person. However, most recently enacted corporate governance codes call for a separation of the role of chairman and CEO. That is, these roles are not exercised by the same individual. The chairman's main responsibility is to ensure that the board is effective in linking with the owners, setting the company's direction and conditions for achieving the desired results, as well as monitoring the performance of the company. The CEO's key role is to assume the lead in putting the long-term strategy into operation so as to achieve the results within the conditions specified by the board. Best practice: the roles of the chairman and the CEO are separated in order to create a clear distinction between the oversight role of the chair and the executive role of management. Some closely held and family-owned businesses might find the separation useful. Indicator 15 Frequency of meetings. Board meetings should be held regularly. In line with best practice, 6 to 10 meetings are likely to be appropriate per year. At a minimum, 4 board meetings per year, with a maximum interval of 4 months between meetings, is possible. More than monthly meetings would be considered excessive. Some committees, in particular the Audit Committee of listed companies and SOEs, tend to meet with greater frequency, sometimes on a monthly basis. Too few board meetings means work is not being done, or the board does not understand its role. Too many board meetings could mean that the board is overly involved in management and may also stem from a misunderstanding of the role of the board. Best practice recommends that boards meet with sufficient regularity to properly discharge its duties. Indicator 16 Induction. Director induction involves introducing new directors to the people with whom they will be working and explaining how the board operates. It involves building trust, rapport, and credibility amongst directors. New board members need to receive sufficient training and background information to function properly. Preparing a board member for effective board contribution is referred to as induction training. Best practice: new board members receive induction training. The level of training reflects the size and complexity of the company. Indicator 17 Written policies and procedures, board charter and committee terms of reference. Written policies and procedures are necessary to formalize the company's governance. The board should define in writing the terms of reference of the various committees, explaining their role and the advisory authority delegated to them by the board. These terms of reference should be reviewed by the board on a periodic basis. The board relies on corporate secretaries and internal and external auditors to provide assurances regarding the quality of the documentation and the systems for implementation. Best practice: the board has a charter, committee terms of reference, and other documentation that define its roles, responsibilities, and procedures. Indicator 18, Code of Ethics. An organization's ethics are the established values and principles it uses to inform and conduct its activities. These describe the moral and ethical climate within which the company wishes to operate. A code of ethics should be sufficiently detailed to give clear guidance, accompanied by a training program, and should be widely communicated. In addition to the code of ethics for the board itself, companies are expected to have a written ethics code for staff and connected parties, suppliers, consultants, agents, and systems to ensure that the precepts of the ethics code are understood, agreed to, and being followed. The board needs to ensure that this is done. Best practice recommends that the board contributes to and ensures that a company code of ethics exists and is implemented. The purpose of the code of ethics is to reduce risk and increase performance by demonstrating the company's commitment to the highest standards of ethical behavior, encouraging proper ethical conduct and sanction misconduct within the company and its connected parties, and developing an ethical culture implementation system based on such standards and conduct, led by the company's directors and management and followed by employees and connected parties. A standard code of ethics will include the company's values, the company's ethical principles, ethical standards for the company's relationship with its stakeholders, for example, employees and officers, customers, business partners, government and community, social and environment. Implementation description, for example, processes and responsibility, means to obtain advice, and training programs. Indicator 19, Evaluation. Evaluations of the board's and company's governance practices are typically considered a first step to improving governance. Evaluations can be self-evaluations or externally assisted. An evaluation should lead to a governance improvement plan which is implemented under board supervision. Evaluations must be used for two specific reasons: assess performance and ensure that director skill sets bolster corporate strategic objectives and guard against possible risks. Best practice: the board conducts continuous informal discussions and assessments of effectiveness and a formal annual evaluation of the company's governance practices. A plan for the formal evaluation of the board's governance practices, either self-evaluation or assisted evaluation, should be an item on the board agenda. The results should be discussed and a plan to remedy defects put in place. An evaluation should have clear terms of reference so as to include the board, individual director performance, committees, the CEO and chairman in the process. The TOR should also state the reason why the evaluation is being undertaken, for example, identification of board weaknesses and providing opportunities to take action and improve itself, or assessing the value of the board to the company and the efficiency of its internal functioning. A typical evaluation process is led by the chairman, but frequently outside experts provide assistance. The process comprises an evaluation instrument, example, the Corporate Governance Self-Assessment Tool, a board presentation involving a description of the process, a questionnaire, which directors complete individually and privately, one-on-one confidential interviews, data collection and analysis, a presentation and board discussion involving the development of a plan to remedy any identified deficiencies. CGMF Key Area 5, Disclosure and Transparency. Indicator 20, Disclosure. Transparent disclosure is one of the key elements of good corporate governance. Closely held and family businesses typically have lower disclosure requirements. However, some of them may find it in their interest to maintain a high level of transparency towards the public, for better stakeholder relations and to increase their general level of accountability. listed companies are expected to disclose to relevant stakeholders and to comply with the disclosure requirements of securities regulators and stock exchanges. State-owned enterprises are to disclose at the same level as listed companies. Best practice: all material information is disclosed to relevant stakeholders. The benchmark of good practices in corporate governance disclosure, developed by the Intergovernmental Working Group of Experts on International Standards of Accounting Reporting, the ISAR, consists of over 50 disclosure items covering 5 subject areas. All of the companies in Trinidad and Tobago must comply with the Companies Act, Chapter 81(1), Number 35 of 1995. This law mandates companies to disclose to shareholders comparative financial statements, reports of the auditor, if any, and any other information relating to the financial position of the company or operating results required by the articles of the company, its bylaws, or any unanimous shareholder agreement. Companies are also mandated to disclose any material interests by directors as defined in Section 93(6). Corporate governance disclosure mandated by this Act is found in Section 1131 and relates to the notice of meetings that must be given to shareholders, directors, and auditors. Companies are also required to disclose in their annual returns filed in the company's registry any changes in the types of shares issued, the shareholding, the execution of mortgages and bills of sale that bind the company's assets, and any other encumbrances to the company's assets. Best practice suggests that the board develop or approve an information disclosure policy that addresses authorized persons, disclosure rules, public information, information provided to shareholders, confidential information, and insider information. Indicator 21. Accounting Standards. The board's financial oversight of the company's activities is required to ensure financial stewardship and provide users with the appropriate information to make decisions. IFRS is the mandatory internationally accepted accounting standard. Closely held companies, listed companies, and SOEs are all expected to be able to comply with IFRS disclosure. Best practice: compliance with the reporting standard, which is International Financial Reporting Standards. Indicator 22. Auditing Standards. International standards of auditing are the internationally accepted standard for the audit of financial statements. Closely held companies, listed companies, and SOEs are all expected to have their financial reports audited according to ISA. Best practice: the audit standard is International Standards of Auditing. CGMF Key Area 6. Shareholders. Indicator 23. One share, one vote. The principle of one share, one vote means that all shareholders are treated equally on a proportional basis to ownership. Where there are different shareholder groups, there is always the possibility that certain decisions may impact these groups differently. The board is therefore responsible to all shareholders equally, and it is the board's duty to ensure that all shareholders are treated equitably. Best practice: the board ensures that the legal rights of different shareholder groups are respected, and that different shareholders are treated equitably and fairly, and that minority shareholders are protected from abusive action by controlling shareholders. Indicator 24. Annual General Meeting. The Annual General Meeting is also referred to as the General Stakeholders Meeting. It is a meeting usually required by law and/or the Articles. An AGM is typically held annually to elect the board of directors and inform shareholders of previous and future activities. It is an opportunity for the shareholders to receive and approve the company's accounts for the past year, to hold the board to account, and ask questions regarding the directions the business will take in the future. Best practice: AGM held annually and processes allow for the effective participation of all shareholders. The CGMF has been specifically organized around the 24 indicators of the 6 key corporate governance areas and is designed to provide support as you engage in the 3-phased process of building your corporate governance practices.